Welcome to the deep dive, where we cut through the noise of corporate earnings and get straight to what really matters.
And today we are really tearing into a big one.
We're looking at the third quarter 2025 performance for Occidental Petroleum, that's OXY. And this quarter, it's a game changer for them.
It really is. This isn't just about the numbers, it's about a fundamental shift in the company's entire identity.
Exactly. So our mission today is to look at two things happening at once. First, their operational performance, which was, just exceptional.
They absolutely crushed their production targets.
They did. But right alongside that, we have to analyze this massive strategic pivot they just announced.
The sale of their entire chemicals business for nearly $10 billion.
Right. We need to understand the whole context here, the debt, the tax implications, and some really interesting environmental liabilities they're holding on to.
When you dig into the source material, you see it's a story of incredible execution paired with a huge risky bet on the future.
So the headline for you listening is this. This quarter is all about top-tier operational skill meeting, a single, incredibly aggressive move to slash their debt. Let's dig in.
Let's start with the engine room then.
Yeah, the operational figures that made all of this possible. OXY reported net income of, $661 million?
Or 65 cents per share.
Yeah.
But you and I know for a company like OXY, that's not the most important number.
Not at all. With their debt load, it's all about cash flow.
And the cash flow numbers are seriously compelling. Operating cash flow before working capital was a massive $3.2 billion.
Which is great, but what did that leave them with?
It led to a quarterly free cash flow, again before working capital, of $1.5 billion.
So they are genuinely churning out cash. This isn't just paper profits.
Not at all. This is real deployable cash. And it's overwhelmingly coming from one place.
The oil and gas segment.
Exactly.
Yeah.
That segment alone generated $1.3 billion in pre-tax income. It just proves what they are at their core.
An exploration and production company, first and foremost.
And the reason those numbers are so strong comes down to one thing. Production outperformance.
Right. Total company average production was 1,465,000 barrels of oil equivalent per day. That's MBOD for short.
And that number beat the high end of their own guidance. When management sets a high bar and the teams on the ground beat it, that says a lot about efficiency.
No question, especially in the Permian Basin, which is their crown jewel.
Production there alone was 800 MBOD. Just a powerhouse.
So I have to ask, was this just pure operational genius, or did they get a little lucky with prices this quarter?
It's a fair question. I'd say it's mostly efficiency. The price environment was helpful, but it wasn't a boom.
Okay.
Average worldwide crude prices only went up by about 2% from last quarter. They realized just under $65 a barrel.
So $64.78. Solid, but not, a record breaker.
Exactly. The fact they beat production guidance so handily at those prices is what's really impressive here.
I did see domestic gas prices gave them a nice little boost, though.
Yeah, up 11% to $1.48 per MCF. Every little bit counts.
And what about their other segments?
The midstream and marketing segment also outperformed, bringing in about $93 million pre-tax.
Okay, so solid performance across the board.
It was. And what's interesting there is they hit that number even with higher expenses from their low-carbon venture businesses.
So a little hint that they're still investing in the future, even while they're making these huge changes?
That's a little one, yeah.
Okay, so that strong cash flow, that really gives us the context we need for the next piece of this.
A big piece.
Let's move from those stellar operations to the seismic strategic decision that is going to change OXY forever, the sale of OxyChem.
This is the definitive move. In October 2025, they announced the deal to sell OxyChem to Berkshire Hathaway.
For a staggering amount of money.
$9.7 billion. All cash. This isn't just trimming a non-core asset. This is selling an entire historic division of the company.
Right. OxyChem has always been that stable anchor for them, hasn't it? A kind of hedge against volatile oil prices.
Absolutely. A very steady, profitable business.
So why sell it? Is management just looking for an easy payday to throw at their debt problem?
Well, the CEO's stated reason is all about one thing. Speed.
Speed to deleverage.
Exactly. The official line is that this sale will let them strengthen the balance sheet and accelerate shareholder returns by focusing only on oil and gas.
And they're putting their money where their mouth is. They plan to use most of the after-tax proceeds.
An estimated $6.5 billion.
To go straight to paying down debt. Their goal is to get their principal debt balance below $15 billion.
It's an incredibly aggressive target. But as you said, it comes at a cost.
A huge cost to their business model, right?
It absolutely does. And this is the critical point for anyone holding OXY stock.
Mhm.
If this deal closes, their entire business becomes way, way more exposed to the ups and downs of the energy markets.
They're giving up that chemical stability.
In exchange for pure focus and a much cleaner balance sheet
Mhm.
is a massive bet on the future price of oil and gas.
Now, you mentioned a clean balance sheet, but let's talk about the fine print here, because this sale isn't exactly a clean break, is it?
No, and this is the crucial detail. You could almost call it the poison pill in the deal.
What's that?
An OXY subsidiary is going to retain the environmental liabilities from OxyChem's old sites.
So they sell the asset, but keep the historical baggage.
They do. And what's more, OXY itself is guaranteeing the cleanup obligations for those legacy environmental issues. They're selling the profit center, but holding on to decades of potential cleanup costs.
Wow. So they get the cash, but they keep the risk.
A lot of it, yes.
Which brings us perfectly to our final segment, a look at the whole financial landscape and all the risks OXY is juggling right now.
Even without the OxyChem deal, it's a complicated picture.
Let's start with the debt. They're making progress already, right?
They are. They paid down $1.3 billion just in Q3. That brought their total debt down to around $20.8 billion.
And they also had that warrant exercise earlier in the year that helped.
Right, back in April. That brought in nearly $900 million, which they used specifically for near-term debt.
What I find interesting, though, is how they've structured that debt.
It's very smart. As of the end of the quarter, about 94% of their outstanding debt is fixed rate.
Which is a huge hedge against interest rate hike.
A massive one. It gives them certainty and predictability on their costs while they work to get that balance below $15 billion.
Okay, so that's a tailwind, but they've also got a big legislative tailwind helping them out.
The OBBB Act.
The One Big Beautiful Bill Act, which passed back in July.
That's right. It's a major tax and spending bill, and it has some really favorable stuff in there for energy companies.
Specifically.
Things like accelerated depreciation and letting them immediately deduct R&D costs. This isn't small stuff.
So what's the bottom line impact?
It's expected to significantly reduce OXY's 2025 cash tax liability. More cash stays in the company, which means more cash is available for paying down debt.
It's a huge, unexpected boost for them. But these tailwinds are being pushed back by some pretty serious headwinds.
Namely, those environmental liabilities we were just talking about.
And the scale is just massive.
It's staggering. As of September 30th, they already have almost $1.9 billion in accrued environmental cleanup costs on their books.
Across 155 sites.
But that's not even the scary part.
What's the scary part?
They estimate a reasonably possible additional loss of up to another $1.9 billion on top of that.
So you're talking about a potential multi-billion-dollar environmental bill just waiting out there.
Potentially.
Yeah.
And we know where the biggest risks are.
That would be the Diamond Alkali Superfund site, or DAS.
A very famous, very long-term problem. The current estimate for just one part of that site is $1.4 billion. Another part is $440 million. These are huge defined costs they have to manage.
And if that wasn't enough, there's one more massive risk hanging over them.
The big one. The lottery ticket.
The U.S. tax court dispute from the Anadarko acquisition.
Yeah, this is all about the $5.2 billion Tronox deduction. It's incredibly complex, but if OXY loses this case...
They're on the hook for a lot of money.
A lot of money. About $1.4 billion in federal and state taxes.
Plus interest.
Plus nearly $900 million in accrued interest.
So as of this quarter, that's a potential $2.3 billion payout that is completely out of their hands. It's just waiting on a judge's decision.
It is a massive risk that has nothing to do with how well they pump oil out of the ground.
Okay, so let's wrap this up. What we have with OXY is this dual narrative. On one hand, they are hitting peak operational form.
Setting records, generating tons of cash.
And on the other, they're making this enormous structural change, selling off a huge piece of their business to throw all that cash at their debt.
And the net effect is you get a much leaner, much more focused company, but also a much riskier one.
Right. Their future is now completely tied to two things they can't fully control.
The price of oil and gas.
Right.
And their ability to manage these huge, lingering legal and environmental liabilities. They've traded stability for speed.
Which brings us to our final thought for you to consider. Given OXY's $9.7 billion choice to go all in on E&P and get their debt below that $15 billion line.
What single event could throw a wrench in the whole plan?
Exactly. What major geopolitical or commodity price shock, something totally outside of OXY's control, would be big enough to completely derail that deleveraging strategy?